Welcome to Buy, Hold, Sell. My name is Matthew Kidman, and today we've got a thematic. Companies buy things, then they sell them, they buy them back. What value are they creating for shareholders? With me today, Simon Shields from Monash Investors and Jeremy Bendeich from Avoca. Welcome, gentlemen. Simon, I'll start with you. Spin-offs, we've seen BHP, spin-off South 32, we've seen a few others over time. Does that actually create value, or is it just noise for investors?
Often, Matthew, when a large corporate spins off a business, they're doing it at the bottom of the cycle, they're doing it under some stress. It often doesn't create very much value at all for the corporate, often creates a bit of value for the people that are lucky enough to buy the asset. Think of Orica selling off Incitec Pivot just as the resources cycle was starting to pick up, or Lend-Lease. What it did when it sold off MLC, it was under some stress, and of course that presaged quite a big share price collapse in LLC.
So you go with what's spun off rather than stay with the old vehicle?
Yeah.
Okay, Jeremy. We also saw it with NAB recently with Clydesdale Bank. It's been a thorn in their side, spun it off. Everyone thought that was good. Do you like spin-offs, or do you got to be cautious?
I think I agree with Simon. You've always got to think about the motivation for the seller, and you like to buy off a desperate seller. But you also have to be very careful about the type of business that's being sold. If it's pretty opaque, especially a bank like Clydesdale, we're Australian investors. It's a whole different set of regulatory regime up there in the UK, and I note that they're actually changing their negative gearing laws up there pretty severely to restrict that.
Right.
And Clydesdale's one of their key growth strategies is to grow its loan book in mortgages. So it always comes down to the particular nuance of the seller. So you've got to be pretty careful, and sometimes there's a lot of cost that has to go into these businesses because they've been starved of capital.
Well, that's another point. Sometimes that works for them. The parent company have starved them because they've got other issues to deal with, and sometimes that capital is required, and they do get a kick on.
They do. And what tends to be the case is you've got a new set of management in there, or an old set of management, but they're freed from the shackles of the corporate, and they've got incentive structures. And that's another thing that you've got to look at. How are those management's incentive structures put together so that they align with creating a lot of value? And if you get the magic mix of a half decent business which has been starved of capital and a great bunch of management that are well aligned, you really can create some value.
All right, let's turn to mergers, Simon. We all know that merchant bankers run the financial markets, and investors are recipient of their decisions. Mergers and acquisitions, sometimes they work, sometimes they don't. Telecommunication industry, deregulated in the 90s, then a whole bunch of mergers from a whole bunch of companies that came out. Do you like mergers and acquisitions, or once again, do you have to be very, very sceptical about what's going on?
Well, it depends what sort of consolidation that's occurring. If it's an industry consolidation, it can often be a very good thing. Think about the banking industry in the 80s and 90s in Australia. The telecommunication industry, I think, is prone to that, because when you can increase the scale of the players in an industry, there are scale benefits. Also, if they're very similar businesses, then a lot of costs can be taken out at the same time. On the other hand, if it's a company that's putting together some sort of conglomeration of assets, as we saw in the 1980s with all those entrepreneurs, I don't think it's a good idea at all.
How do you feel about it, Jeremy? Do you think we're just being hoodwinked by people trying to generate fees, or is there good value in industry consolidation?
Investment bankers are always trying to hoodwink us and generate fees. We can accept that, but I think that what we look for in this M&A behaviour is we go back and strip out the M&A to try to keep tracking the underlying core organic growth of the business. It's made
hard to do sometimes, though.
Hard to do because they often keep changing their accounting because they're trying to hide something. But if you've got some really good in-market synergistic acquisitions, like TPG's acquisition of IINet on the day it announced it put on $1 billion of market cap, and that was something that created a lot of value for shareholders. So it really comes down to having a business that's doing essentially what Simon said, good acquisitions in market, but with a strategy behind it, as opposed to just buying things.
But Simon, you get roll-up stories and you get acquisitions and companies get hooked on it. QBE being an example, has been unwound for a long time. So is it that organic growth that we're going to concentrate on, or is there other factors?
The best thing you want to see is an industry that's got strong organic growth, the wind at its back, and is very fragmented, and so that you can get a roll-up story like that. So QBE appeared to have that for a while, but it's like Jeremy said before, when you've got an opaque business, it can be very hard to understand what's going on, and that's a real danger sign. On the other hand, you can think about Sonic Healthcare and pathology. It was a roll-up. More recently, we've seen Green Cross and G8, childcare and obviously vets. And in the early stages, those things did very, very well, quite straightforward businesses.
So it's an example here where you've got to do your analysis. Some work, some don't, but be very careful.